you.
What an incredible week. I mean, we've seen these U.S. job numbers. They were below expectations, but I think people and investors are kind of trying to look beyond just, the 155,000 jobs that were created in November and kind of focus on unemployment. And then you've got this to and fro. Is the Fed going to cut? Is it going to increase rates down the line? Is it going to hold steady? Stephen, let's start with you. I mean, are you seeing that the fundamentals are playing a stronger role than all the kind of panic and uncertainty that is plaguing investors' minds?
Well, look, there's a fundamental disconnect right now between what the economy is doing, which is really well, and the stock market, which is doing really poorly. And I think that's in no small part because of the anticipation of, problems on this trade front. If Trump can get this done in 90 days and they get a good trade deal with China, the economy is going to go through the roof. But look, looking at the fundamentals of the economy, my goodness, I mean, manufacturing is strong, construction is strong, industrial production is strong, housing is weak, but almost every other signal is pretty strong. There's going to be a slowdown in the economy in the fourth quarter, but there's nothing, this idea that there's some kind of a sugar high with the U.S. economy, I don't see it. I think we're built for 3 to 4% growth for the next few years.
Okay, Diane, I know that your prognosis has been that we'll see the Fed starting to cut rates at the end of 2019. And actually this week, we saw something very interesting happening with those U.S. bond yields where we saw an inversion coming through. It seems that there's been sort of a sea change in the way that people are viewing the Fed. The Fed is even talking about, halting on raising rates. What can we start pricing in?
Well, I think it's really important. We are going to get a December rate hike. The economy is slowing, but is still going to be strong enough through much of 2019 to justify another 2 rate hikes. And then I do think there's going to be weakness at the end of 2019. I think part of that weakness is due to trade uncertainty, to tariffs, to the ongoing tariffs. None of the tariffs that have been levied have been rolled back yet, even though we got tentative agreements on trade with Mexico and Canada. We still have tariffs there. And there are more cracks in the foundation that I see than Steve does, and that's in terms of corporate debt. By the end of this year, we'll see a doubling of interest rates over the course of the year, which is doubling of interest expense, and we have a lot of high-yield debt out there in the corporate sector that's going to be rolling over next year, and I think that's a bit of a problem. Housing's another canary in the coal mine.
Can I just say one thing in response to that? Yeah, you're exactly right, Diane. The corporate debt is problematic. But, you mentioned that the Fed rate increase. I mean, why in the world is the Fed raising rates? It's they shouldn't have raised them, in my opinion, 2 months ago. We've got declining commodity prices. The real measure of inflation is what happens with commodities. They've been falling, and not just oil, but copper, corn, wheat, silver. I think what's happened, the story of the stock market, frankly, is Trump called it right. When the Fed came out with that disastrous rate hike a couple of months ago, ever since then, the Dow has been on a slow burn, and I think that there's no reason for another rate hike. In fact, the Fed has to be getting dollar liquidity into the economy, not taking it out.
Diane, I see you shaking your head there. Go for it.
Yeah, I am. I appreciate it, Stephen. I mean, we're going to subtly disagree on this. I do think what the Fed has been doing is correct, even though I do expect the economy to weaken in late 2019. They're responding to the current environment. The current environment is just acknowledging the strength that we've had. And frankly, we don't even have Fed funds rate that's at neutral yet. It's not even a real Fed funds rate that's positive yet. So in that sense, we still have very accommodative monetary policy. And I think, it's really interesting how people were complaining about the Fed not raising rates fast enough, and now all of a sudden there's been this 180 that they're complaining they're raising them too quickly. They are going to slow the pace of rates. They're very cognizant of economic conditions, and they are pivoting from seeing tailwinds to seeing some headwinds, which Governor Brainerd actually made some comments on today. And I think what's really important, and I feel good about with the Fed, is that they are paying attention to these issues. The problem is the Fed only has a limited amount of tools, and the reality is they can't deal with combative policies like tariffs, which are tax hikes, and tax cuts at the same time. Much of this year, we had the tax cuts cushion the margin squeeze of tariffs, the tax hikes. As we go into 2019, the stock market's looking at that and saying that's not going to be there. And I'll tell you, a lot of my clients are not happy about it. And for those farmers that are hoping to get bailed out, we've already seen bankruptcies in the farm sector surge to their highest level since 2010.
Okay, Diane, do you think, with what you've just said, is there a sense that we could head into a much slower growth environment if we don't see these rate cuts? And if, there's a talk about a possible recession down the line, is that what you're pricing in if we don't see the Fed acting, as you say?
Well, I've got the Fed slowing its pace of rate hikes, and I think that's a good thing. I think the Fed is going to acknowledge the fact that the U.S. economy is slowing down, but I do think it's a difficult game to play, that they just don't have all the tools necessary to combat a recession once we get there.
Well, my view is the Fed is causing the recession. I mean, if we get a recession, it's because the Fed is so tight. And look, Diane, what I don't understand is how you can justify a rate increase when we have declining commodity prices. I mean, it just doesn't make any sense to me. I mean,
well, they're turning around right now today. I mean, the commodity prices are not the only inflation out there.
But they're the best measure, right? I mean,
no, they're not the best measure. No, core inflation is the best measure. They're only one measure of inflation. Wages are picking up. We are going to see some service sector inflation. I do think inflation, we've got a strong dollar, which helps to temper that, but tariffs are stagflationary. So we've got all these cross currents out there that the Fed's dealing with. They have to respond to the reality, and the reality is we do have things pushing prices up. Every client I know is going to test the waters on price hikes in January.
Yeah.